two global banks, 2 days, two downgrades. First, HSBC, then JP Morgan, both cutting their rating on Indian equities. And markets reacted exactly how you would expect. Sensex fell nearly 1,000 points on Thursday. Nifty broke below 24,000. The question every investor is asking right now is simple. Should I be worried? Well, let us look at the data. JP Morgan has downgraded India from overweight to neutral. That is a significant shift. And they gave four specific reasons: elevated evaluations relative to emerging market peers, earning risks, dilution concerns, and limited exposure to next generation technology. Now, let us break each one down. Reason 1: valuations. India has historically traded at a scarcity premium because of its high growth and policy stability. But that premium is now becoming a problem. Even though India's valuation gap with the MSCI index has narrowed down to 65% versus the 109% peak premium, Indian equities still trade at a significant premium to peers like Korea, Brazil, China, Mexico, and South Africa. These are the markets that offer an inexpensive entry point for similar or higher earnings growth. Simply put, for a global fund manager, choosing between India and cheaper alternatives with similar growth. So, India is no longer the obvious answer. Well, we'll go into reason 2, which is earnings risk. JP Morgan has lowered its earnings growth forecast by 2% to 11% for the calendar year 2026 and 1% to 13% for calendar year 2027. Why? The reason being crude oil at $106 per barrel and rupee at 94 per dollar. Surging crude oil prices could fuel inflation and dampen growth prospects. Higher energy costs may squeeze consumption and reduce corporate margins in the near term. Now, let's go to reason 3, which is dilution, that nobody is talking about. Strong domestic inflows of $120 billion since early 2025 have cushioned foreign outflows. But a surge in IPOs, QIBs, and promoter stake sales is capping upside for existing shareholders. More supply of shares, but same demand. Prices get capped. Now, if you go to the reason 4, India is missing the AI wave. JP Morgan flagged India's limited exposure to next generation technology. The brokerage has turned more constructive on Asian technology stocks, upgrading Taiwan to overweight amid a renewed artificial intelligence rally. Taiwan has semiconductors, South Korea has chips, India has services. In the AI supercycle, services is not where the big money is going. So, what should you actually do? JP Morgan is overweight domestic cyclicals, financials, materials, discretionary consumption, defense, and power. It has an underweight stance on IT and pharma. So, that is the roadmap, not panic selling, not ignoring the risks, but rotating towards sectors that can withstand oil pressure and still grow. JP Morgan's base case target for Nifty 50 stands at 27,000 for year end 2026. From current levels of 23,900, that is still a meaningful upside. Of course, the path will be volatile. So, should you panic? No. Should you be alert? Absolutely. When two of the world's most powerful financial institutions raise the same red flags in the same week, you do not ignore it. You understand it, you adjust, and you invest with discipline. Because in markets, panic destroys wealth, but informed positioning builds it. Thank you. This is Kabal. Do not forget to subscribe, like, and comment.